Now we're going to move on to the tax treatment of the corporation who is liquidating all their assets. So this is the liquidating corporation. Generally, we follow our same treatment we've been doing before, where we treat this like a sale at fair market value. So the corporation is going to recognize gain or loss. They're going to treat this transaction as if they sold their assets for fair market value on the date of liquidation. And then there are going to be restrictions in the case of loss. We'll talk about those in a minute. Tax attributes generally disappear when a corporation liquidates. So these are net operating losses, earnings and profits, things like that are just going to disappear. And if we have liquidations of 80% controlled subsidiaries of the parent, the liquidating corporation is going to recognize no gain or loss, and the tax attributes are going to carry over. So if a subsidiary is liquidating into a parent and the parent controls 80% of the subsidiary, we're not actually going to recognize any gain or loss because really the business is going to continue in the parent. Section 336 applies to the corporation side of the liquidation. 336A provides that, except as otherwise provided in this or Section 337, gain or loss will be recognized to a liquidating corporation on the distribution of property in complete liquidation as if such property were sold to the distributee at its fair market value. If there are liabilities and the property is distributed in liquidation subject to the liability or the shareholder assumes the liability, then for purposes of subsection A and section 337, the fair market value of such property shall be treated as not less than the amount of such liability. So if the fair market value is less than the liability, then we're going to treat the fair market value as equal to the liability. And we're going to note that this rule is only applicable to the corporation. This is the corporate rule. And in this section, we have the exceptions. And the exceptions are, there are two exceptions. They're found in 336D1 and 336D2. 336D1 is going to deal with related persons. And then 336D2 is going to deal with transactions that appear to be for tax avoidance. So we'll start with the 336D1 related party exceptions. And these are going to disallow losses. So 336D1A is going to disallow a loss if the property is distributed to a related person if, 1, the distribution of loss is other than pro rata. That means you distribute lost property and you don't distribute it in accordance with the person's relative ownership of the corporation. If I have a 60% shareholder and a 40% shareholder, and I'm distributing all my assets, and I have one loss asset, and I distribute it 100% to the 40% shareholder and none to the 60% shareholder, that is not pro rata. So 336D1A would disallow that loss because if it was distributed to a related person, if 1, the distribution is other than pro rata, or it's disqualified property. Okay, and then skipping down to 336D1B, disqualified property is any property acquired by the liquidating corporation in a Section 351 transaction or as a contribution to capital during the 5-year period ending on the distribution date, or any property having an adjusted basis that carries over from disqualified property. All right, so remember when they talk about property acquired in a 351 transaction, that's when we formed the corporation. If we formed it and everyone was allowed a tax-free formation, then it would be a 351 transaction, or if it was a contribution to capital, so a shareholder contributed it, during the 5-year period ending on the date of distribution, so the previous 5 years. All right, so we said this is going to apply if the property is distributed to a related person. So now we need to talk about related persons. That is found in Section 267B. And you covered Section 267 in your intro tax course, so your basic individual tax course. I am going to click over there and we are going to look through it again. All right, so section 267 disallows losses, that's what A1 says, in the case of related parties. The related party relationships are found in section B. Okay, so the people who are related are B1, members of a family as defined in C4. All right, and you can scroll down here and read C4. For our purposes, the family relationships are not as important, so I'm going to go on. B2, an individual and a corporation, more than 50% in value of the outstanding stock which is owned directly or indirectly by or for such individual. This is the relationship that is going to matter most to us for these purposes. So a corporation and a shareholder are treated as related if the shareholder owns more than 50% in value of the outstanding stock. All right, and they can own it directly or indirectly. So if a shareholder owns 60% of Corporation X, the shareholder and Corporation X are related. Since they are related, there's going to be limitations on distributions of lost property. B3, two corporations which are members of the same control group. 4, a grantor and a fiduciary of any trust. 5, 6, and 7, and 8, and 9 really are not super important to us. 10, a corporation and a partnership if the same persons own more than 50% in value of the outstanding stock of the corporation and more than 50% of the capital interest or the profits interest in the partnership. 11, an S-corp and another S-corp if the same persons own more than 50% in value of the outstanding stock of each corporation. 12, an S-corp and a C-corp if the same persons own more than 50% in value of the outstanding stock of each corporation. So you can see, reading through these, the common theme is somebody owns more than 50% in value of the organization. If you have that, you probably have a related party transaction. Okay, so remember, these exceptions are relevant because they disallow losses in a liquidation transaction. D1 disallows losses to related persons, and they are disallowed if either the distribution of the loss is other than pro rata or the property is disqualified property. And then disqualified property is defined in D1B, and it's property acquired in the 5-year period ending on the date of distribution that the corporation acquired either through a Section 351 transaction or as a contribution to capital, or any property having adjusted basis that carries over from disqualified property. So a transferred basis situation. Here's an example that shows why that rule exists. All right, so assume Sam, shareholder, contributed property with an adjusted basis of $1,000 and a fair market value of $500 to Corporation X in a transaction that qualified for Section 351 treatment. Okay, just pause and look at this asset. The asset as an adjusted basis of $1,000 and a fair market value of $500. So if Sam sold that, Sam would realize a $500 loss. And maybe this asset is a capital asset in the hands of Sam, and so he wouldn't get to really take the benefit of that loss, so he contributes it to the corporation. Okay, now 351, without any limitations, would ordinarily allow Sam to take a $1,000 basis in his shares, because remember, it's a transferred basis. So when he contributes that to the corporation and he gets shares in return, he would take a $1,000 basis in those shares. And X would ordinarily, without any other limitation, take a $1,000 basis in the asset that it receives. So in this transaction, there is essentially, we've magnified the loss because we now each have a built-in $500 loss. Now assume 3 years later, while the asset has the same fair market value, Corporation X liquidates and distributes the property back to Sam. Okay, in that case, assuming no limits, Sam would be allowed to take a $500 loss because the transaction is measured at fair market value, which is $500, and his adjusted basis in his shares is $1,000. The corporation would also take a $500 loss, essentially 2 losses for the price of 1. Section 336 D1A is going to say D1A2 is going to say, no, corporation, you cannot take that loss because the property is disqualified property. All right, we are not allowed to take the loss twice. So absent another provision, Sam would get to take the loss, but Corporation X could not take the loss. However, this is an instance where tax law changes over time, and sometimes the corresponding provisions aren't adjusted to really make sense. Remember back when we studied Section 351 and how there was a limit on lost property contributions through 351. Okay, so we have to consider this transaction in conjunction with Section 362E2. And that section requires that the corporation take a fair market value basis in assets where the adjusted basis exceeds the fair market value. So this situation would not have happened because Section 362E2 would require that Corporation X take a $500 basis in that asset, which essentially greatly reduces the need for this 336D1 related person loss exception. But it's still on the books because it wasn't adjusted after 362E2 was added to the code. Okay, the next loss limitation provision is 336D2. And this limits losses that the liquidation seems to be for a tax avoidance purpose. So 336D2 says there's no loss recognition on the sale, exchange, or distribution of property acquired in a Section 351 transaction or as a contribution to capital where the liquidating corporation acquired the property as part of a plan of loss recognition by the corporation in connection with liquidation. Lost property acquired by a Section 351 or contribution to capital within 2 years of liquidation is going to be presumed to have a tax avoidance purpose. So if we have this situation, we have a different basis for computing loss than for computing gain in a liquidation transaction. The basis for loss is going to be the adjusted basis at the time of liquidation reduced by the excess of the property's adjusted basis over its fair market value immediately after the contribution. And this calculation is essentially going to limit the loss recognition to a loss that accrued after contribution, not the built-in loss that happened at the time of contribution. A basis for gain is going to have no adjustment. However, again, you have to read this in conjunction with 362E2, which basically makes this provision inapplicable because 362E2 does not allow a built-in loss at the corporate level. It limits that. And another difference between 336D1 and 336D2 is that 336D2 disallows all of the loss. 336D2 would only allow a portion of the loss. It would disallow the portion of the loss that was built in at the time of corporate formation, but it would allow the loss that happened between corporate formation or contribution and liquidation. Lynn Wallace contributed assets with a $100,000 adjusted basis and a $400,000 fair market value to Ace Corporation in exchange for all of its single class of stock. The corporation conducted operations for 5 years and was liquidated. Lynn received a liquidating distribution of $500,000 cash, less federal income taxes owed on the liquidation by the corporation, and the assets that he had contributed, which now have a $100,000 adjusted basis and a $500,000 fair market value. Assume a 21% corporate tax rate. A, what are the tax consequences of the corporate formation transaction? All right, so A, on the corporate formation transaction, right? So this is where 351 would apply or would not apply, depending on the parameters of the problem. All right, so he is a 100% shareholder, and he exchanges assets solely for stock. So 351 is going to apply. He would realize a $300,000 gain, but he is not going to recognize it per the provisions of Section 351. Since he does not recognize any gain, his basis in the assets is a transferred basis, so it's $100,000. So his shares have a basis of $100,000. Part B, what are the tax consequences of the liquidation transaction? So upon liquidation, the corporation is going to distribute cash and the asset. The asset has an adjusted basis of $100,000 and a fair market value of $500,000 to the corporation. So we're going to look at both the liquidation on the corporate side and on Lynn's side. Okay, so first, the corporation is going to recognize a $400,000 gain because they have this asset that's worth $500,000, and they took a $100,000 basis in it because Section 351 applied. So Ace Corporation recognizes $400,000 gain on the deemed sale of the asset when it distributes it to Lynn. Remember, we pretend like we sell the assets for fair market value and distribute them. They are going to pay tax on that gain at 21%, and the taxes would reduce the cash distribution to $416,000 because after you pay the taxes, you have less cash to distribute. Lynn would recognize an $816,000 gain because he receives cash of $416,000 and he receives the asset, which is worth $500,000. So he receives in total $916,000 worth of cash and assets, and he has an adjusted basis in those shares. So remember, we treat this like a sale of our shares for assets. So the gain is $816,000. Part C, would your answers to Part A and B remain the same if instead the assets had been contributed by Wallace Corporation to Ace Corporation? If not, explain how your answers would change. Okay, so now we have a parent-sub relationship. That's what they're trying to get here. So instead of it being an individual shareholder, it's a corporate shareholder. So Part A would not change. 351 applies whether or not we have individual contributor shareholders or corporate shareholders. So that would not change. Part B is going to change because remember, if a sub is just liquidating into the parent, we don't recognize gain or loss on that. And then the tax attributes would carry over. So the answer to Part A would not change because 351 applies to the formation of a subsidiary as well as a general corporate formation. Because of the parent-sub relationship, though, the liquidation is covered by Sections 332 and 337, which provide that Ace would recognize no gain or loss when it distributes the assets to Wallace. And then Wallace recognizes no gain or loss when it exchanges the Ace stock for the cash and the assets. Because of that, the appreciated assets basis to Wallace will be a transferred basis. It'll be $100,000. Wallace will have $500,000 of cash, and the tax attributes will transfer. So the earnings and profits and any net operating losses, any of that will transfer over now. All right, and problem 6-36, we want to know what are the amount and character of the gain or loss recognized by the distributing corporation when making liquidating distributions in the following situations. What's the shareholder's basis for the property received? In any situation where a loss is disallowed, indicate what changes would be necessary to improve the tax consequences of the transaction. A, Best Corporation distributes land having a $200,000 fair market value and a $90,000 adjusted basis to Tanya, its sole shareholder. The land, a capital asset, is subject to a $40,000 mortgage, which Tanya assumes. Okay, this one's pretty simple. The only thing they've thrown in there that is making it a little more complicated is the liability. And we know that on the shareholder side, the assumption of a liability reduces the measurement of the amount received. So it would reduce the value of that fair market value. On the corporation side, the limit would only come into play if the liability was more than the fair market value of the asset, which doesn't apply here. So in Part A, it's $110,000 capital gain measured as the fair market value minus the basis. All right, so that is the result to Best Corporation. Best Corporation has a $200,000 amount realized minus the $90,000 adjusted basis. So they have a $110,000 gain. We can't say the tax consequences to Tanya because we don't know the basis of her shares. But what we do know is that the amount she realizes in the transaction will be the $200,000 land minus the $40,000 mortgage she assumes. So the amount realized will be $160,000. From there, we'd subtract her adjusted basis and her shares to determine her tax consequences. B. Wilkins Corporation distributes depreciable property to its two equal shareholders. Robert receives a milling machine having a $50,000 adjusted basis and a $75,000 fair market value. The corporation claimed $30,000 of depreciation on the machine. The corporation purchased the milling machine from an unrelated seller 4 years ago. Sharon receives an automobile that cost $40,000 2 years earlier and has a $26,000 fair market value. The corporation claimed $25,000 of depreciation on the automobile. Okay, here, remember, we're going to pretend like we sold these assets for fair market value on the date of distribution. So on the shareholder side, if we had done that, we would have gain, but some of it would be recapture because we've taken depreciation. So we'll start with the machine. We'd recognize $25,000 of ordinary income, not capital income, and that's because it has a $75,000 fair market value and a $50,000 basis. The $50,000 basis is due to the Section 1245 depreciation recapture. So the $75,000 basis is the basis in the property received. The car, again, we're going to have some ordinary income, and that's because of depreciation recapture. We have a $26,000 fair market value minus the adjusted basis, and the adjusted basis is the cost minus depreciation taken. All right, so, and we have a $26,000 basis in the property received. Part C, Jordan Corporation distributes marketable securities having a $100,000 fair market value and a $175,000 adjusted basis to Brad, who is a 66.67% shareholder. Jordan purchased the marketable securities 3 years ago. Jordan distributes $50,000 cash to Ann, a 33.33% shareholder. Okay, here it is important to note that Brad and Jordan Corporation are related parties because Brad owns over 50% of Jordan. So we know in that case, if we have losses, we might have a limitation or a disallowance of those losses. We will have that here because Brad owns 66.67% of the corporation, but Brad received 100% of the loss asset. The loss asset is the marketable securities. It has a $100,000 fair market value and a $175,000 adjusted basis. So that loss is going to be disallowed. All right, so it would be a $75,000 capital loss, but it's disallowed because the corporation distributes those securities entirely to Brad, which is a non-pro rata distribution. Brad has a $100,000 basis in the property received and receives $50,000 cash. If the corporation has capital gains from other transactions, it should consider selling those securities, recognizing the loss, and then distributing the sales proceeds to Brad. Because it doesn't matter either way to Brad, and that way the corporation could use those losses to offset some gains. Part D, assume the same facts as in Part C, except the securities and cash are instead each distributed 2/3 to Brad and 1/3 to Ann. So now, since it's a pro rata distribution, the loss from Part C is fully deductible. The corporation distributes the stock and cash ratably to the two shareholders. All right, in that case, Brad has marketable securities with a $66,667 basis plus $33,333 of cash. So Brad still received $100,000 worth of assets. So for Brad's purposes, it doesn't matter between C and D, but it matters to the corporation because the corporation can now deduct the loss. And then Ann has marketable securities with a $33,333 basis plus $16,667 of cash. So she still received the same amount of asset, $50,000. Now looking at problem 38, Titan Corporation adopts a plan of liquidation. It distributes an apartment building having a $3 million fair market value and a $1.8 million adjusted basis, and land having a $1 million fair market value and a $600,000 adjusted basis to M&O Partnership in exchange for all the outstanding Titan stock. M&O has an $800,000 basis in its Titan stock. Titan has claimed $600,000 of maker's depreciation on the building. M&O Partnership agrees to assume the $3 million mortgage on the land and building. All of Titan's assets other than the building and land are used to pay its federal income tax liability. A, what are the amount and character of Titan's recognized gain or loss on the distribution? All right, so in part A, we have the building, the land, and then total over there. So we know the amount realized is the fair market value of the assets. That's given to us in the problem. It says the building has a $3 million fair market value and the land has a $1 million fair market value. We also have the adjusted basis there of each, which is how we get the realized gain. So building, land, we have a realized gain of $1.2 million and $400,000 respectively. And there's no provision in there not to recognize that gain. So it's realized and recognized. The building, remember, the depreciation on the building would be section 1250. It would be covered in section 1250. But for corporate purposes, section 291 is going to require that 20% of the depreciation taken on the building is going to be recaptured as ordinary income. So of that $1.2 million gain, $120,000 is going to be ordinary income. The rest is going to be 1231 gain. And then the land, we know we don't depreciate land. So the entire $400,000 gain on the land is section 1231 gain. There's no recapture there. Part B, what are the amount and character of MNO partnerships gain or loss on the liquidation, and what's the basis for the land and the building? So MNO partnership received those assets. It also assumed the mortgage, and its basis in the stock was $800,000. We know that the assumption of a liability is going to reduce the amount realized. So here in Part B, they would have a $200,000 capital gain, and that's because they received $4 million fair market value worth of property, the building and the land, but we reduced that by the assumption of the liability, which is $3 million. So we have a $1 million amount realized minus an $800,000 adjusted basis. So we'd have a $200,000 capital gain. The basis of the land is $1 million, and the basis of the building is $3 million. They take a fair market value in that. And then finally, Part C, how would your answers to Part A and B change if the mortgage instead was $4.5 million? All right, so that's going to change A because the fair market value can be treated as no less than the value of the liability. And the total fair market value is only $4 million, but the liability is valued at $4.5 million. So we have to treat the fair market value as $4.5 million. All right, so you can see here, the amount realized, the deemed fair market value, the total is $4.5 million. We allocate that based on the relative fair market values. So the building comprised 75% of the total $4 million fair market value, and the land comprised 25%. So when I take 75% of $4.5 million, I get $3,375,000. 25% is $1,125,000. From there, I subtract the adjusted basis to get the realized and recognized gain. On the building, Section 291 is going to require me to recapture as ordinary income either the lesser of the entire gain or the gain attributable to depreciation. So here that's the gain attributable to depreciation, $600,000. Just like in Part A, I'm going to have to recapture $120,000 as ordinary income, and the rest will be Section 1231 gain. On the land, it's all going to be Section 1231 gain.